This is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. Of course, we've got a great live show for you this evening, and we're going to talk a lot about not only the economy, but the investment markets. More importantly, this show is all about you, the listener. Our number's at the bottom of the screen. Please call us with your questions and your concerns. Every week we literally receive dozens of phone calls from our TV listeners, questions about stocks or bonds or mutual funds, questions about the difference between suitability and fiduciary standard of care. We get a lot of calls and questions about people who were unfortunately sold and misrepresented about annuity products or structured products or maybe managed future products, which I'm going to talk a little bit about tonight. Our number's on the bottom of the screen. When you call that number, you can give your question to a studio producer, and then I'll take your question while you listen on your sofa, and you just watch the TV and get the answer that you need to make better decisions about your portfolio. Also at the bottom of the screen is our website, reznywealth.com, and our phone number for our office. Our office, of course, is located in Naples and in Fort Myers, in addition to offices on the east coast of Florida. We always enjoy talking to new potential clients. So if you find that the advice you're getting is not really advice at all, if you're finding that your portfolio hasn't really gone anywhere, if you're realizing the firm that you thought you were entrusting your money to really is just a brokerage firm or a wolf in sheep's clothing, call our office for a consultation. We would love to help you. We'll take a look at your portfolio. We'll tell you exactly what's going wrong. And more importantly, we can help rebuild and get you on the right track in a fiduciary capacity or in your legal best interest. The one thing that I want to talk about today is complex products. Every single month, not only in our offices, but on my radio and my TV show, we keep getting new clients coming in or questions coming into our various programs about complex products. Investors were sold by brokerage firms, whether it's the big broker dealers you hear about all the time that constantly get fined, whether it's the independent broker dealers, whether it's these so-called advisors or these annuity salespeople. At the end of the day, what investors have to understand, and I want to repeat this clearly, complex products do not belong in your portfolio. The only reason brokers or so-called advisors and brokerage firms and insurance companies like to manufacture and sell you complex products is to basically line their pockets, not yours. So what I want to suggest is this. Before you buy any investment that you truly don't understand, make sure you read the fine print. Better yet, never buy a complex product because they are usually ladled with fees and commissions and rob you of your money and returns. In fact, let me talk about one that to me is highway robbery. How investors lose 89% of their gains from futures funds. Complete details are on my website. If you go to my website, reznywealth.com, we've got our resources tab. Click on it. We've got our investment insight blog. You can read the whole article there. This article was written by Bloomberg about a month ago, and the article is entitled How Investors Lose 89% of the Gain. And the article talks about various broker-dealers. One that they cite in this particular article, and they've got a lot of great research on this, was Morgan Stanley. Morgan Stanley sold a product that was the Spectrum Technical Managed Futures Fund. And what's interesting is there was a lot of problems not only for Morgan Stanley once they sold this fund, but also for you, the investor, who unfortunately the product was misrepresented. What's interesting is this particular futures fund, which is highly complex and the fees are horrific, over a 10-year period from 2000 to 2002, and by the way, all these statistics are in this article, the fund actually made about $490 million. The problem is you, the investor, didn't get one penny of that over that 10-year time frame because the fund expenses were almost $500 million. So investors actually end up losing from that 2000 to 2012 time frame $9 million, and you made zero money. So at the end of the day, folks, before you buy one of these highly complex products through any of these broker dealers, make sure you understand what you're buying into. If you've bought a managed future fund from any of these broker dealers and you've lost money or haven't made any money, I would suggest you visit my website, reznywealth.com. Click on the resource tab, and you'll see our investment blog clearly indicated. Click on that. This article is from Bloomberg, and it's entitled, How Investors Lose 89% of the Game. Now, I don't think managed future products are the only bad apple out there. In fact, Wall Street and insurance companies love to develop annuities, whether it's equity index annuities or whether it's variable annuities. These things are toxic to your wealth. In fact, if you go to my website right now, reznywealth.com, we've got a great report that we wrote about annuities and why annuities are dangerous to your wealth and your retirement. I would suggest you go there and download any of our reports. We try to give you the facts so you, the investor, can make better decisions about your investing. But that article from Bloomberg, it was right on. It told investors exactly why these things are toxic, all the hidden agenda, the conflicts of interest that that firm had against their clients. But guess what? They sold almost $800 million of that fund to their clients. I can pretty much rest assured there's probably not a lot of happy clients at that firm, considering over a 10-year period you lost money. I'm sorry. At the same time, the equity markets made quite a bit. So what I'm going to suggest is this again. Do not buy highly complex product that are riddled with fees. If you don't understand it clearly, then you should not buy it. Don't be sold your portfolio in a complex product like that. When you have a brokerage account, not an advisory account, you are responsible. Continuously throughout my TV and my radio show, I get a lot of calls and questions about, I thought my broker, who calls himself an advisor, actually managed my money and was watching out for my best interest. Far from the fact. If you have a brokerage account, and by the way, I would estimate about 90% of investors have a brokerage account, not an investment advisory account, okay, which is far different. In a brokerage account, the brokerage firm and the broker does not have a legal obligation to work in your best interest and can put their own interests well ahead of yours. But with that, when you have a brokerage account, unfortunately, most investors falsely believe that the broker or advisor, even though he or she is a really nice person, is actually responsible to manage and watch over that portfolio. They are not. Under most circumstances in a brokerage account, you, the investor, are 100% responsible. And if you read most of these complex disclosure statements from brokerage firms, it'll tell you exactly that. Too often what I'm finding is this. Investors call my office, they sit down with us to review their portfolio because they're unhappy and disgruntled with the firm they're currently using. When we explain to them that you currently have a brokerage account, not an advisory account, and that firm that you work with can put their interests ahead of yours, they're kind of shocked. So again, make sure you understand the difference between a brokerage account and an investment advisory account, and understand the difference between suitability versus a fiduciary standard of care. Falsely believing that your firm or your advisor works in your best interest, unfortunately, is the crux of the problem for the majority of investors, the conflicts that they see and the losses and the bad performance of their portfolio. Larry from Fort Myers, Florida. How to rebalance your portfolio that is heavy in bond mutual funds, mainly the PIMCO Total Return Fund. Larry, that's a great question. I can firmly tell you throughout 2013, the vast majority of the new clients that have hired our firm at Rezny Wealth Management overloaded the boat in bonds. They thought bonds were conservative. The broker wants to sell you what you want to be sold, unfortunately, and bonds were not the right ingredient for the recipe. So what happens is this. I'm seeing, again, still, even though we're getting towards the end of 2013, a lot of investors are so overloaded in bond mutual funds or bonds in general that have maturities more than 3 years. This is a big mistake. In fact, if you look at most of these bond mutual funds and a lot of bond investments, year to date, a lot of these things are negative, 2, 3, 4, 5% year to date negative when the equity markets have done quite well. The reason that you want to avoid most bond mutual funds and most bonds in general is the risk you're going to have when rates slowly move up. When rates move up, your bond values go down. What I would suggest, Larry, again, I don't know all the other bond funds you own. I would suggest you call our office. We do have an office right in Naples and in Fort Myers. Call our office. The number is at the bottom of the screen. Schedule a consultation with my firm. We can go over your portfolio. We can talk about our investment management and how we can help you basically achieve an adaptable portfolio to changing investment conditions. So unlike most investors who have that pie asset allocation on their brokerage statement, where you have stock and bond related, sometimes you don't want to own a lot of traditional bond mutual funds, and you want to be in areas of the market right now for income that we own in the floating rate security side. So I really think you need to look at your overall portfolio, get an assessment, and as I always tell our TV and radio listeners, Larry, it can't hurt to talk and get a second opinion. Sometimes we want to wait and watch and maybe it'll get better. I can firmly tell you, I don't think rates are going much lower. I think ultimately people who have overloaded the boat in bonds over this next decade coming up are going to be recipients of not only low return, but potentially losses in their portfolio as interest rates slowly inch up. Sue in Bonita Springs, Florida. How would you recommend a 70-year-old person invest $500,000 of new money at this time of high market valuations? This money is in addition to a pension of $100,000 per year. Sue, that is a great question. Number one, you do have an underlying cushion, which is your pension plan, which is great. So again, not understanding your risk profile and your goals and objectives, it's going to be hard for me to tell you how to invest that money in a short answer on the TV show today. I would suggest you do call the office and schedule a consultation. But with that, I want to go back to your comment about high market valuation. First off, the market, or if we're referring to the stock market, is not highly valued. Now, is it at a new high? Yes. Market valuation is different. The price of the stock market or any investment has nothing to do with the valuation. As an example, if you bought a car that's worth $10,000 and you paid $5,000, well, the value of the car, of course, is you paid is $10,000, but you only paid $5,000. So there's a difference between the price and the actual value of the asset. I would tell you this: if I look at the economy in general, not only in the U.S., but in Europe, and Europe's coming out of a recession, things are getting better. If I look at the emerging market economies, getting better. Generally speaking, valuations in the U.S. are trading at about an average valuation around about a 14 to 15 PE ratio to next year's numbers. That is well within an average or a little bit down average valuation, meaning there could be upside return continued. If companies continue to earn more money, which I firmly believe they will, if we get GDP expansion and expansion of PE ratios, price to earnings, we could see the markets potentially go higher. But what I'm going to tell you is this, Sue. At Rezny Wealth Management, we run a very adaptive strategy. And what that means is we don't just buy the stock market or the bond market or real estate or gold. We look at all asset categories, and we only own those categories that are relatively strong or in an uptrend. Now, of course, one of the things that too many investors do is they do called asset allocation. So they own strong assets with weak assets going down, which basically drags down the return of your portfolio. As an investor, relative strength investing and how we manage client portfolios does a couple things. A, it's adaptive to changing investment conditions, and not just conditions in the stock or bond market, but all asset categories. And number two, we look at that relative strength so we know what assets to own, and look at relative weakness, what assets we want to sell. Too often investors own everything, and as an asset's going down for a prolonged period of time, like I believe we're going to see in the bond market, investors that keep holding too much money in traditional fixed income are going to be recipients of either low returns or loss of principal. Bill in Bonita Springs, Florida. My advisor recommended I put my Roth IRAs into a MetLife annuity. Is that good? Absolutely not. Never, ever, ever put your IRA accounts, whether it's Roth or regular IRA, into an annuity. You clearly have a salesperson that sells annuities. Your person is not an advisor. I want to stress that. The only advice they're giving you is what's going to line his pocket the most. Annuities are cost-ridden. Your IRA and Roth IRA account are already tax deferred. There's no reason to put it into an annuity, no matter what sales job that person tells you. Bottom line is this: low-cost ETFs, exchange-traded funds, would be a better option. I would suggest you fire your advisor because he's not giving you advice at all, and he clearly does not work in your best interest as a fee-only money manager under a fiduciary umbrella. Because of that, it's important that you understand the difference between suitability and fiduciary. Your person that you're working with is working under suitability. His interest is to sell you the highest commission product that lines his pocket versus what's best for your portfolio. I'm going to take a short break. I'll be right back with more calls and your questions after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. And we're back. I hope you're joining today's program. And of course, if you're concerned about your portfolio, if you're concerned about the advice you're getting, is it really money management, or are you being sold investment products that are better for that brokerage firm, the insurance company, or that bank investment representative at the local bank? If you're concerned about your money, if you're realizing your portfolio is not doing well for you, but it's doing better for the guy selling you the investments their firms represent, what I would suggest you do is this. It cannot hurt to talk and get a second opinion. Our number's at the bottom of the screen. Call our office. We have offices in Naples and in Fort Myers, and of course we have offices on the east coast of Florida in addition. If you're concerned about the advice you're getting, or I should say lack of advice, or is it really money management at all, and you've got that failed Wall Street asset allocation pie, call our office for a consultation. There is a difference, and we invite you to experience that. We would love to help you. You can also go to my website, which the address is at the bottom of the screen. Go there. We've got some great information. We also have 2 workshops coming up. We have our Adapt or Fail investment workshops. They are perfect for retiree and pre-retiree couples. If you want to learn the most valuable investing and retirement information you'll ever learn, that will help you protect your retirement portfolio and learn to avoid the conflicts of bad investment advice, I urge you to go to my website right now, ReznyWealth.com. We do have limited seating, by the way, but we do have an upcoming workshop right here in Fort Myers, and we have another one in Boca Raton. You can sign up. It's free, and I'll tell you this, it's packed with great information that will help you move your portfolio in the right direction and avoid the conflict of salespeople. Keith in Cape Coral, Florida, you've been a big advocate of the small cap sector the majority of this year. Do you still feel that small and mid cap stocks will continue to do well into the end of 2000 in this year and 2014, and why? Keith, we haven't been a big proponent of small and mid cap. We've owned them because our strategy ranks all the asset categories based upon relative strength. So we own relatively stronger investment sectors in an uptrend. Our strategy is a lot more complicated than that, but the way to explain it is this. It's like a horse race. If you want to have a chance to win a horse race, you race your fastest horse, not your slowest horse. And so what we basically do is we look at all investment sectors broad-based around the world, not just stock and not just bond, but all different asset categories. And cash is one of the asset categories, by the way. We rank those on a proprietary system, and we own those relatively stronger sectors. Through 2013, the majority of this year, we've owned small and mid-cap ETFs or exchange-traded funds within our managed accounts at Rezny Wealth Management. And yes, they've done exceptionally well. If they continue to be highly ranked in our top ranking, we'll continue to own those through the rest of this year. If for some reason they start to falter and things get weak in the economy and those assets start to get weak, we'll sell them if they fall out of our top ranking system. So what's going to happen between now and the end of the year? We currently own them, but our positions can change at any time if a change in circumstance happens with those particular sectors and they get weak. I'll give you a great example. At the end of 2012, we owned the GLD, which is the iShares Gold share. It owns physical gold. As we got into 2013, at the end of 2012, gold fell out of our top ranking and it fell to number 7. Because it fell out of our top ranking, it's automatically sold, and it was replaced with the iShares IJH, which we still own, by the way, so that's a fair disclosure. And if we would have kept gold, gold's down about 20% year to date. IJH that replaced it, which was relatively stronger, is up about over 20%. So the thing is, asset allocation, or that failed Wall Street pie that I call it, would still own gold even though it's weak. And what would that have done to the IJH or the midcap? It would have dragged it down so investors wouldn't have made any money. So at the end of the day, a sound investment strategy is important, but that strategy's got to be adaptive. Right now, small and midcap are towards the top of our ranking. As long as they continue, we'll own them. I would listen to future shows to see if we do make a change in that allocation. Linda in Fort Myers, Florida. My husband and I each have a Roth IRA and trust accounts. Our advisor has all in variable annuities through Pacific Life, and you have repeatedly warned about variable annuities and why they can be, and why annuities, and should we get out? Excuse me. Linda, this is what I'm going to tell you. Clearly, the person you're utilizing is working under what's called suitability. Under suitability, you have a commission-based advisor. That person's interests are different than yours. They can sell you expensive, mediocre investments in annuities, which your IRAs and trust account do not belong, because they work under suitability. They do not have a legal obligation to work in your best interest. You only have to be suitable for the investment, but it doesn't have to be the cheapest or the best. I would fire your advisor quickly, and I would use the term advisor loosely, because he's clearly a broker using a fancy title, and he put all your money into Pacific Life variable annuities. That is not right at all. I can tell you from our research at Rezny Wealth Management, variable annuities in general have an average expense ratio, the ones that we've reviewed, between 3.5% and 4.5% a year. That is ridiculous. All that does is it robs you of the return you should be making. And most of these variable annuities have mediocre to lousy investments. So you couple mediocre to lousy investments with high expenses, that's going to take away from your return. Your broker is a broker. He's selling you what's better for him to line his pockets versus your retirement. You've gotten bad advice. I'm sorry to say that. What I would offer you is call our firm for a consultation. I despise annuities, but we understand them. We can take a look at what you've got, see if we can get you out without a lot of harm, and point you to a better direction of real portfolio management under a fiduciary standard of care. Our website's at the bottom of the screen, ReznyWealth.com. Also, you can go there and download our free report, Why Annuities Are Dangerous to Your Wealth, and How to Avoid Outliving Your Money During Retirement. You can also go to our website, ReznyWealth.com, and sign up for a consultation, and we'll also put the number at the bottom of the screen if you'd like to call that right now. Charles in Naples, Florida. Brian, I have the failed pie you discussed. 42 mutual funds and ETFs for an account size of $750K. We've done poorly. Is it easy to move our accounts to your firm? When is your next workshop? It's extremely easy to move your accounts to Rezny Wealth Management. We use an outside custodian, actually TD Ameritrade, that actually custodians our client assets, but we're the money manager that manages the overall funds. It's very easy. We actually will do all the paperwork for you. What I would suggest you do is call our office for a consultation. You can schedule it at Naples or Fort Myers. We'll sit down. Let's take a look at your portfolio. 42 investments, though, mutual funds and ETFs in a $750,000 portfolio. That's called the failed pie. What happens is, this is what shows up on too many brokerage statements. This is when you know you've got asset allocation at its worst. Too many investors hire brokerage firms who they falsely believe are actually managing their money. What most of these firms do is they spread it all over. So you own the relatively stronger assets with the relatively weaker assets. So you own the good and the bad, and what does that do to your portfolio? At the end of the day, that's not a strategy. That's just somebody who wants to asset gather your money and basically park it in a whole bunch of mutual funds and ETFs. I can tell you from a lot of experience and research that my firm does every day, when you start to get past 5 to 6 to maybe 7 asset categories in a portfolio, what you're essentially doing is not reducing risk, but it's watering down the return of the stronger horses. Remember I talked earlier about the fastest horse wins the race? That's the relatively stronger asset. Well, if you've got 25 horses, you know your fastest horse and you know the slowest horse at the end. If you own all 25 horses, what's that going to do to your average speed in the race? It's going to bring it way down. Why not own the stronger assets instead of the big failed pie of everything? What you're doing doesn't work, and unfortunately, you're probably going to see miserable returns and falsely believe that you're actually managing risk by over-diversifying the portfolio. Tom in Naples, bank loan funds, can you explain? Yes, Tom. In fact, Rezny Wealth Management right now, in our income portion of many of our managed accounts, we own various bank loan funds. Basically what these are, they're usually the shortest maturity in the fixed income category. And I would suggest if you're somebody who's trying to protect some of your money from interest rate fluctuation, bank loan funds can work quite well because they're extremely short maturity, usually under 90 days. So what that means is as rates go up, you don't see the deterioration or downward pressure on the value of your asset like you would see in a mutual fund that's got a 3 or 4 year maturity. So at the end of the day, what I would suggest is this. Look at bank loan funds as a way to diversify your income portion of your portfolio. As rates go up, you can get a correspondingly higher rate without the necessary heartburn of the value going down like on a traditional mutual fund. I hope you enjoyed today's program. I hope you learned a lot. Our website is at the bottom of the screen, reznywealth.com. I want to put my number up there one more time also. Call our office right now, 800-618-8577. Call us for a consultation. You would benefit from a consultation if you want less stress over your investments, you want a firm that works 100% in your best interest as a fiduciary, as a fee-only money manager, and risk management is an important part of how we manage your wealth. Make sure you have yourself a safe and profitable day, and please contact our firm and visit our website.